Distinguished guests, dear colleagues, I am honored to welcome you to the research conference on the macro-financial impacts of climate change and the net zero transition, jointly organized by Banca d'Italia and the Bank of England and hosted by the Banca d'Italia Milan regional branch. I am also pleased that a fair number of the participants are attending the event in this conference room, although with several restrictions and inconveniences that the pandemic emergency is still imposing on us. The discussion of the papers will benefit of the warmth and enthusiasm that only personal interactions can deliver. On the other hand, the improvements in our ability to make use of information and communication technologies allow us to enlarge the set of contributors and attendees to an extent that would have been otherwise impossible. I hope that the hybrid form of the conference will be conducive to constructive discussions, and the high-quality research presented here will provide guidance to the policymakers that are addressing tough choices on vital issues. I would like to thank all the colleagues, all the people at the bank, both in Rome and in Milan, that have contributed to make this event possible. I, therefore, wish you a fruitful and productive work. Thank you for being in Milan, be it in person or online. Governor Visco, I suppose that is online.
Okay, thank you very much, Giorgio. I hope you hear me. Good afternoon, good morning, good evening to everyone. I'm obviously delighted to open this two-day conference on the macro-financial impact of climate change and the net zero transition. This is a conference that is jointly organized by the Bank of England and Banca d'Italia. And given the circumstances, as Giorgio Gobbi just mentioned, the conference will take place in a hybrid format, and I welcome then all participants, those in presence in Milano, as well as those connected from remote. The analysis of the economic implications of climate change cuts across the issues traditionally covered by macroeconomic research, exploring topics such as growth, technological change, international trade, the role of global financial markets. Nevertheless, we are still struggling to fully grasp the complex interactions with and the transmission channels of climate change to the economy. The transition to a net zero economy, which is essential to limit warming below 2 degrees Celsius, will also have material impacts as well as significant implications for monetary and fiscal policies. This conference aims to stimulate discussion between policymakers at central banks and the leading academics. It marks the end of a long journey with the G7 and the G20 presidencies working together to scale up global action in the fight against climate change. And we expect this conference to be an insightful step prior to the COP26 meeting a few days ahead in Glasgow. The conference is divided into 4 sessions. The first 3 sessions focus on the frontier of research in understanding the economic impacts of climate change and the transition to net zero economy. Each of them consists of 2 presentations of 20 minutes each and 20 minutes of questions and answers, and is chaired by an academic or a policymaker. The final session is a panel discussion aimed at linking the academic findings to real-world policy. Let's now hear the introductory remarks of the Governor of the Bank of England, Andrew Bailey. Andrew, the floor is yours.
Well, thank you, Ignazio. It's a great privilege and pleasure to be hosting this conference alongside the Banca d'Italia and to welcome what is a very distinguished list of both speakers and attendees over the course of both today and tomorrow. Central banks and regulators, financial regulators, have been amongst those who have stepped forward and risen to the climate challenge in recent years. The Bank of England, we started to first approach the work on climate back in 2015, really through assessing the risk in the insurance sector, because we recognised that that was a very long run risk, which would sort of go over the horizon, if you like, and even as seen at that time. And since then, we've developed supervisory expectations. That was in 2019. And more recently, explored the system-wide impacts of climate change through scenario analysis. And even more recently, and I would say in some ways nascently, by studying the role of monetary policy and how climate change is going to affect the macroeconomy. And so it's been interesting to watch and be part of that evolution. It's interesting to see where we are today. And frankly, as this conference, I think, is going to add huge value to the challenges that we have taking this work forward, both in terms of actually, of course, acting on climate change, but also in the understanding of it, and therefore what we should do. Now, it's not for central banks to be the lead on climate change. That rests with governments. But what we can do, obviously, is and must do, is consider the impact of climate change and the transition to net zero on our economies, on the world economy, and on our financial systems. And that's what we've been doing. Ignazio and I have been doing that actively this year for the G7 and the G20, which we've collectively been acting as chairs and presidents for. But it's only been possible to make the progress I think we have through close collaboration with peers, academia, industry. And as I said, there are many remaining unanswered questions. Now, of course, it's a good and familiar thing for those of us in central banking to look to work with, particularly academia, to take forward and enrich our understanding of these issues. And this is no different. There is a lot to do. There's a lot to cooperate on, and a lot of, frankly, joint understandings that we will come to as a result of this work. So let me just share a few thoughts on how I think and areas I think we can work together. First of all, and I mentioned the point about horizons earlier, the window, I think, for responding to the climate change challenge is closing. But the challenge is now also much clearer than it was before. I think collective efforts, scientists, policymakers, academics, industry, with increasing, I think, pace and impact, has really articulated those risks, shed light on them, and helped inform the response we need to make. And from that, we know in our world that climate change matters for the stability of the financial system. It matters for the macroeconomy. Actions that we will take in the decade ahead will determine the climate outcome, looking a long way beyond that. And that the longer we wait, the greater the physical impact on our climate and the more transition risk we will face. And that we need a mix of climate policy tools to facilitate a successful transition. So it's natural, it seems to me, that the attention has now turned to how we can systematically quantify those transmission channels into our economies, into our financial systems, better understand the interdependencies that exist within that world, and explore how these change depending on the different policy paths that could be taken. And that's, of course, where scenario analysis comes in. At the Bank of England, we're undertaking a scenario exercise, CBES, CBES as we know it, we love acronyms, to assess the resiliency of the financial system to different climate scenarios. The exercise uses the different scenarios that we've developed with other central banks and with other regulators and with a consortium of climate scientists under the macro financial work stream of the Network for Greening the Financial System. Forgive me, another acronym, the NGFS. And many now other central banks and policymakers are using those scenarios, and my colleague Sarah Breeden is going to say a bit more about them shortly. And with these, we're going to assess the economic and financial outcomes of different combinations of physical and transition risks over a period of decades. They're pretty ambitious, frankly, in that respect, but necessarily so. And in the face of uncertainty, exploring different potential future paths is really crucial to informing the decisions of policymakers, investors, businesses, and households today. But none of this is easy. It's actually pretty heroic when you start dealing with scenarios of this nature. And this type of analysis, scenario analysis, it's a growing field. It's a pretty new field, actually, especially when we apply it into the financial system and into the macroeconomy. So there are challenges, but inevitably. There are data gaps. There are methodologies that need to be developed. And while I think the climate science is fairly clear, there are obviously considerable uncertainties about how it sort of passes through into future economic and financial impacts. So that's a call, if you like. That's a call for help, for more work to refine the methodologies and approaches. And there are gaps, of course, in our toolkit, but those gaps can't keep us from making progress and applying the tools that we have to make progress. So allow me to mention some of the areas I think we should focus on that do require pretty inventive, collaborative, and fairly timely and very timely solutions. We need to integrate climate and macro modelling further. We're only really I would say, in the early stages of that. Both of them, of course, have got unique insights to offer, but on their own, they don't get us near to the task. They've got to come together. So we need models that integrate the two fields, and ones that, of course, give us, certainly in our need, usable macroeconomic depictions, and allow us to, in a sense, focus in particularly on those risks that are most apposite for what we do. Now, a lot of progress has been made, but there is more to do to integrate models across different disciplines. I mentioned previously, I think ensuring that we best understand the different economic impacts of different climate policies. Within climate models, the level of geographical granularity is referred to by specialists as the, quote, spatial resolution of the model. That was a new one on me, I have to say, but that's good. For central banks, supervisors, policymakers, and I think firms, we must increase the economic resolution of these climate economy models. I think we also have to go beyond aggregate impacts to understand distributional outcomes across sectors and across geographies. We talk a lot about that, but we've got to really begin to get some models that actually allow us to get a real grip on it. The NGFS is currently looking into whether it can expand its scenarios with a sectoral model, attempting to increase that degree of focus. But I'm sure there's further work that will need to be done in that field. And I think it's important to understand and emphasise how important that will be for effective policy making. It will allow us, I think, to have better targeted policies towards transition. And it means that we can also, look at across this distribution of outcomes and better understand how different sectors and different regions will be affected. So I think what that will do is help central banks and supervisors, better understand the risks to our financial systems and to our economies. Now, third, we should assess how the transition to net zero might impact the demand and supply sides of our economies. From extreme weather events threatening food security to carbon emissions policies, climate change and transition-related risks will, of course, have implications for the macroeconomy, and we should seek to understand the dynamics sooner rather than later. I must say, speaking personally, looking at the three scenarios we're using, one of which is a relatively smooth transition, one of which is no transition, and the last one of which is the delayed transition, which has to be, if you like, caught up in a rather, frankly, not smooth way. In some ways, it was the third of those that was most interesting to me as to just how disruptive that was. And I think there are a lot of lessons to learn from that, which are going to be important in the debate. So these impacts and risks will, of course, become further evident to us over time as we do the work. It's why we've got to have in this analysis both short and medium term and long term analysis. That's different from the usual sort of stress tests we do, which are by comparison very short run. And we will, of course, have to continue to refine our analysis as we learn more on transmission channels. And it will be essential for us as monetary policymakers. I've said a number of times, this is the area, to my mind, that has been very underdeveloped. Now, that may be because it was considered to be over the horizon. But I have to say, and Ignazio and I were both in Washington last week, and this came up a number of times, that when you look at some of the things that are going on in energy markets at the moment, and how you combine that with some of the things that will need to happen on the climate front, it suddenly doesn't look so over the horizon. I think that is a quite a big wake-up call. So we're taking important steps, but we've got a long way to go. So let me finish. That's, I think, where we need to work together to address these challenges. We can't work in isolation on this, it's too important. And of course, the benefits of collaboration are too important. So building our understanding of the right mix of policy tools to support the transition while understanding those risks will be crucial. I'm sure this conference, because having seen how exciting it looks and the papers we're going to hear, will provide an opportunity to take a big step forward on that front in the work we're doing, to advance the thinking we have. So I look forward to it. I think it's part of laying the groundwork for a very ambitious commitment. And of course, it's also timely, because that ambition is also going to be represented at the COP26 conference, which is almost upon us. So thank you very much, and I look forward to the next 2 days.
We have Sarah online.
Ivan.
Hi, Sarah. Welcome to the conference.
Thank you so much.
The floor is yours, Sarah.
Brilliant. It's my great pleasure to be here today too. We are shortly going to start with the first session of the conference proper. But before we do so, I'd like you to just indulge me with a moment so that I can officially launch a new report called Scenarios in Action that's just been published by the Network for the Greening of the Financial System, the NGFS acronym that Andrew highlighted earlier. Scenario analysis is hugely relevant to the discussion today. It's where our understanding of climate risks, economic outcomes, and financial risks come together. And I'm thrilled to be able to share some of the key messages from our Scenarios in Action report with you today. Some of you may know that I have two hats. One hat I am is as Executive Director and member of the Financial Policy Committee here at the Bank of England. But with my other hat on, I chair the macro financial work stream of the NGFS. In June of this year, the NGFS macro financial work stream published the second iteration of its climate scenarios. And today, we are publishing a report that looks at how central banks and supervisors are using those climate scenarios to assess economic and financial risks. If we could go to the next slide, please. This report features climate scenario exercises by 30 NGFS members. To date, only 4 of those exercises have been completed and their results published. But as this is a new field, another 21 exercises are due to be completed within the next 12 months. And I think this attests to scenario analysis as being the leading tool for central bank supervisors, the financial industry more broadly, to size climate impacts. Scenario analysis is so important because to understand climate change, we need to look forwards, not backwards. And depending on our actions today, we could see fundamentally different future outcomes, ranging from a hothouse world with extreme physical risks to futures where we limit the effects of climate change, but potentially face very high transition risks. Scenario analysis is the go-to toolkit to help us understand those futures. Next slide, please. The report that we've published highlights that the objectives of the climate scenario exercises undertaken by NGFS members vary. While all exercises aim to assess risks, the focus of this assessment can range from risk to individual financial firms, to risk to the wider financial system, or risks to the broader economy. Moreover, because most of us are doing this type of climate scenario analysis for the first time, it's often equally as important to use the exercise as a way of promoting awareness of the risks and to develop capabilities for assessing these risks. Those objectives are often as important as sizing the risks. Central banks and supervisors see considerable value in doing scenario analysis solely to learn by doing. Given that methodologies are still evolving and data gaps are still being closed, as Andrew mentioned, no NGFS members as of yet envisage calibrating prudential policies such as capital requirements on the basis of their exercise. However, it's clear that some members have interest in this topic and have indicated that they may include it as an objective for future exercises, which again underlines the importance of the kinds of issues we will be discussing through this conference. Next slide, please. This slide shows some findings with respect to the scope of the climate scenario exercises. All exercises surveyed in the report cover the banking sector, and about half of them also include additional financial firms such as insurers or pension funds. All but one exercise includes transition risks, and about half of the exercises to date also cover the physical risks from climate change. The main reasons for the difference are that transition risks are in some cases perceived to be the more pressing matter for the financial sectors being considered, and they are also comparatively easier to model. However, physical risks are materializing already, and a comprehensive risk assessment will ultimately require us to look at both types of risk. Interestingly, only one of the exercises surveyed includes climate litigation risks. These are the risks that arise when companies or other actors are held legally liable for, amongst other things, losses or damages that result from the effects of climate change, or for greenwashing their products when they make things seem more environmentally friendly than they are, for insufficient disclosure of climate-related information about their activities, or for failing to reduce their carbon emissions. Climate litigation could have a material impact on the stability of those companies, creating risks for investors or for insurers providing coverage for those most likely to face legal action. The slide also shows that exercises range from a macroeconomic to a sectoral focus, and a number of exercises even include detailed counterparty level analysis. Naturally, these design choices will have a bearing on their complexity and therefore the resource cost of the exercise. Next slide, please. For the purpose of this report, NGFS members have been frank about the challenges and the data gaps they have faced in doing climate scenario exercises and about the creative ways in which they have addressed them. I'll not discuss all of this in detail, it's all in the report, but let me highlight just a few points. First, the NGFS scenarios are not often used directly off the shelf, but instead are adapted to fit a jurisdiction's specific circumstance. This presents challenges, and to help address those, we are continuing our work on making the NGFS scenarios more comprehensive, more easy to use, covering more variables for more countries. Second, climate risks are often analysed over long time horizons, and this creates significant uncertainty in the exercise. The report details some of the ways in which NGFS members are addressing this uncertainty, with particular focus on the use of static versus dynamic balance sheets. And then thirdly, data challenges take time to resolve. Even though scenario analysis helps generate relevant data that can help build the full picture, it's a gradual process, and it remains a key challenge that dilutes our ability to fully understand and penetrate all the risks. Looking forward, next slide, please. Looking forward, I can assure you that the NGFS will continue to serve as a platform for knowledge sharing between central banks and supervisors, and will report on these findings as they emerge. In particular, building on this progress report, the NGFS and the Financial Stability Board are planning to publish a joint report in 2022, drawing out the main implications of climate scenarios for financial stability. And the NGFS will also continue to improve its scenarios with the aim of being as relevant as possible for economic and financial analyses, and we will continue to keep collaborating with a range of actors to ensure the scenarios are suitable for wider use, as I hope the report will be as well. I hope that underlines the significant value of the conference today in helping make sure that we are best able to incorporate a detailed, comprehensive, complete understanding of the economic and financial risks of climate change. This conference really could not be more important. Ivan, that's me done with the slides. I think that means we are ready to open the conference. Would you like me to plow ahead?
I think that now you have a third hat, the head of the chairman of the chairwoman of the next session. So the floor is yours again.
Brilliant. Thank you so much. And I'm happy to lose the slides now. Look, it's my great pleasure to open the first session of this conference. The work that central banks and supervisors have been doing with respect to climate scenario analysis would not have been possible if it weren't for the considerable efforts from scientists who, in the course of decades, have built a broad evidence base that allows us to make these future projections. Thanks to those efforts, there's an enormous amount of knowledge about the potential impacts of climate change and about what we can do to prevent those, namely reducing our greenhouse gas emissions. When compared to the physical science basis, research on the impacts of climate change on the economy and the financial system is still nascent. It's crucial for us as policymakers to progress our understanding in this area, and it's especially critical at the current juncture. As Andrew and Ignazio said, we're weeks away from COP26, and it's vital that policymakers take action now if we are to steer the course in an orderly way to net zero by 2050. So to echo our governor, Andrew Bailey, I hope this conference helps lay the groundwork for ambitious commitment underpinned by decisive action and credible work plans at COP26. Now, with my panel, we're off to a great start with two highly distinguished speakers. And I'd like first, please, to give the floor to Geoffrey Heal, who is the Donald C. Waite III Professor of Social Enterprise Economics at Columbia Business School. Professor Heal has had an impressive career as a resource and environmental economist, and amongst many notable achievements, he's chaired a committee of the National Academy of Sciences on valuing ecosystem services, and he was a coordinating lead author of the IPCC's fifth assessment report. Today, Geoffrey will speak to us about transition risk transmission channels. Over to you, Professor Heal. I hope you're with us.
Indeed. Thank you very much for that introduction. Very generous. Great honor to be here. I'm about to try and share my screen with you people. Let's hope that that works. Okay, I think I'm sharing my screen with you. Can you see it?
Yes.
Right. Thank you very much indeed. Great. Okay, so I'm going to give a very high level talk about the economic risks associated with climate change. And I'm going to talk about these at a very high level and about transmission channels. I'm going to divide this into two categories, and any division of these risks, as you'll see, is somewhat arbitrary, unfortunately. There's a huge amount of overlap, however one categorizes these things. But I'm going to try to distinguish between what I call direct climate risks and then risks associated with transition, which are principally the risks associated with the policies that we're going to implement in order to try and mitigate climate change. So I'll talk about them in that order. Now, there's a wide range of what I call the direct risks associated with climate change. I'll go through each of these in a bit of detail, but just to give an overview, there are some direct physical risks associated with damages from climate change. There are agricultural risks associated with the impact of climate change on our food supply. There are risks to the health of human populations. There are risks to our productivity, our ability to get things done. All of these have implications for financial risks, and the financial risks can be extremely diverse, but quite substantial. There are social risks, and perhaps least understood of all, but by no means necessarily least important, there are a wide range of what I'll loosely call ecological risks. And I'll talk briefly about each of these in the next slides. Physical risks are in some sense the most obvious risks. There's damages, physical damages to plant and equipment. So there could be damage from windstorms. We anticipate a big increase in wind speeds and in storm severity as a result of climate change. And we're already seeing quite a lot of this. I mean, so far this year, there have been several hurricanes hitting the US, big windstorms in Europe, and several typhoons hitting Asia, all of which have caused damage in the billions of dollars, in many cases, tens of billions of dollars range. This coastal erosion is something which is occurring in parts of the United Kingdom, parts of the northeastern US, parts of the southwestern US, and other places as well. This is something which is separate from sea level rise. What's happening here is the coast is actually being eroded away, and the cliffs are falling down and buildings on those are being destroyed. This is something which is being accelerated by greater wave action because of higher wind speeds. Another source of physical damage is flooding from rainstorms, and that's been so common so far this year, I hardly need to mention it. But parts of New York were underwater only a couple of months back from the tail end of a hurricane. Parts of Germany were flooded relatively recently. There have been heavy rains in the US. There was massive flooding in China, which has disrupted many people's supply chains. So this is already a fact. It's not something which we're going to see in the future. It's something we're seeing right now today, but it will get worse in the future according to all of the models. Sea level rise, as I said, something distinctive from coastal erosion. We can anticipate as much as perhaps 2 meters of sea level rise by the end of the century. And the impact of sea level rise will be made significantly worse by the fact that we'll have higher wind speeds in the storms that hit. So if you take a combination of a sea level rise of 2 or 3 or 4 feet coupled with stronger storms, the damage can go up quite nominally. Finally, of course, there's fires. And the world has literally been on fire for the last few years. We had fires in California, fires in Oregon, and fires in Washington State, fires in the southern European countries, fires in northern European countries, fires in Siberia, and terrible fires in Australia. I was part of the, as Sarah mentioned, I was part of the last IPCC report, not the current one, but the 2013 report. We actually hardly anticipated the severity of fires in that report. This is something which has really come out of left field. Was quite the significance of this was really quite unanticipated a few years back. And so this, I think, is a good illustration of the potential for significant surprises in the area of even such basic things as physical risks associated with climate change. So my second category is agricultural risks. Probably the biggest risk here is extreme heat. We now know that crop yields can drop dramatically as temperatures exceed somewhere in the region of 30 degrees centigrade, 30, 31, 32 degrees centigrade, depending on the exact crop. Crop yields increase slightly as temperatures move up towards 30 degrees from below, but as soon as you go over around about 30 degrees, yields drop very sharply. And there's plenty of evidence that crop yields in major agricultural areas, crops in major agricultural areas will be subject to several days a year in excess of 30 degrees centigrade in coming years. So we can expect a significant drop in crop yields because of this. The flooding that I mentioned in the previous slide as a physical risk is also, of course, a risk to crops. Crop yields can be greatly reduced by excessive rain. Sea level rise, again, is a source of crop risk, agricultural risk. We can lose land because land is overtaken by sea level rise. We can lose cropland, farmland. But also, even if land is not permanently flooded, saline intrusion can greatly reduce its productivity. So we'd anticipate if there's a sea level rise of 4 or 5 feet, to 2 to 3 meters, let's say, by the end of the century, we can anticipate losing a lot of agricultural land. We can losing that land directly and also losing additional land because of saline intrusion. We're already beginning to see the next point I've got here, which is the spread of pests as climatic conditions change. So pests are spreading, tropical pests are spreading northwards. And the biggest impact of this that I'm aware of so far has been the growth of the spread of the bark beetle here in the US, destroying large areas of forests. I mean, hundreds of thousands of hectares of forests have been killed by the bark beetles. And that's a direct result of the warming of winters, which allow this pest to overwinter and its population to increase. We're beginning to see more of this in other parts of the US, and I'm sure this is happening in other countries as well. Parts of the US have been subject to a massive drought for the last 10 to 15 years, the southwestern US, and other parts of the world also been subject to massive droughts. So again, that's a very important agricultural risk. Windstorms, of course, can destroy crops. So windstorms going through parts of the Midwest can just flatten cornfields, again, greatly reduce the yields. So there's a wide range of agricultural risks, all of which threaten the supply chain of our food. Health risks, another big category, I'm afraid. Obviously, there are physical risks to our health posed by storms, fires, floods, and so on. People are hurt by these directly. There's risks associated with extreme heat. We now understand that, for example, if the wet bulb temperature exceeds around about 95 degrees Fahrenheit, then humans just can't survive in this kind of environment. So that's a wet bulb exceeding 95 degrees is a combination of heat and humidity, which makes it impossible to keep one's core body temperature in sort of 98 degrees Fahrenheit, 37 centigrade range. And current forecasts suggest that significant parts of the world will experience wet bulb temperatures in excess of 95 degrees by sort of the second half of the century. Parts of the Middle East, parts of India, other parts of Asia. We're already seeing the spread of mosquito disease vectors. Mosquito-borne diseases are extending their ranges quite significantly. I do have a personal angle on this. My wife and I have a vacation home in the Caribbean, which we bought about 15 years ago. When we bought that, the region was relatively disease-free. Since then, we've seen dengue fever, Zika, chikungunya, all become endemic within the Caribbean. And I have no doubt at all that malaria will arrive within the next few years. This is happening in many other parts of the world. The range of malarial vectors in Africa is spreading. The range of dengue vectors in Asia is spreading. And these are all serious diseases capable of having a very, very negative impact on people's health. Obviously, the risks from flooding, people drown, people are harmed in flooding. And perhaps something which is less widely appreciated, but there have been a couple of studies recently which show that the risk of industrial accidents increases greatly as temperatures increase, particularly in outdoor activities. Industrial accidents in farming, industrial accidents on construction sites. These have become much more common as temperatures rise. Something which perhaps we don't think about so much is the impact of temperature on productivity. But there's a great deal of evidence that temperature reduces individual productivity. There's a clear sort of physiological evidence of a drop in productivity as temperatures rise above the mid-70s. People just become less effective at doing a wide range of both intellectual and physical tasks. I mentioned the rise in industrial accidents on construction sites in agriculture associated with high temperatures. There's also, again, not so widely recognized, there's a great deal of very convincing evidence that students in schools learn less effectively when temperatures rise. And this can obviously have a negative long-run impact on productivity. Now, financial risks. The point I'd like to really emphasize here is that all physical risks have associated financial risks, because all these physical risks destroy assets or impair the value of assets. And every time you damage an asset, you're doing harm to some entity's balance sheets. And indeed, it goes beyond that. If an asset is financed, then there's a loss of collateral as far as the institution financing it is concerned. So all physical risks, all destruction of assets have financial counterparts through harm to balance sheets and through possible loss of collateral. There's also, of course, the famous stranded asset risks, which the Bank of England has emphasized heavily in the past. The BOE has emphasized stranded asset risks in the field of oil and gas, but actually these asset risks, of course, are much, much wider. For example, plants making internal combustion engines for cars will be relatively valueless, I hope, 10 or 15 years from now. There was a long piece in the Financial Times recently, which some of you may have seen, about the loss in value at General Electric and Siemens, who are two large makers of gas turbines, because of the drop in demand for gas turbines and the anticipation that gas turbines will be much less in demand in the future than they have been in the past. So again, that's a stranded asset, the capacity to manufacture gas turbines. There's a wide range of risks going to be associated with the extensive restructuring of economies which we're going to experience in the next few decades. It's going to lead to a lot of repricing of assets. Now, back in 2008-9, a relatively mild repricing of mortgage-backed securities led to a huge financial crisis. And we can anticipate the possibility of things like that happening in the future. For example, if a lot of homes are devalued by sea level rise, there could be an impact on mortgage-backed securities, which are securities on those which are secured on those homes. It could also be an impact on municipal bonds. I mean, here in the US, many coastal municipalities finance their operations by issuing bonds, and their capacity to generate taxes and finance these bonds could be impaired by sea level rise. So there's potential for systemic effects there because of the impact of sea level rise on property values and on asset values and on tax capacities. It's possible we'll see much more extensive repricing of securities, quite abrupt repricing of securities in connection both with climate change itself and with the transition policies which we're anticipating will be put into effect. Social risks. Massive social disruption is possible because of many of the things I talked about. We could see extensive migration resulting from crop failures. If agriculture in some zone fails on a massive scale, people will migrate out of that area. Flooding, extensive flooding will lead people to migrate. And extreme heat could lead people to migrate. Parts, for example, of the Indian subcontinent become untenably hot in the summer, then we may see large-scale migration there. All of this migration could lead to the growth of failed states, or at least the growth of failed regions within states. The physical risks from storms can impoverish many families. For example, I mentioned sea level rise before. For many families, many middle-class families, obviously their principal asset is their home. And substantial devaluation of homes because of sea level rise, because of fires, because of floods, could lead to a great deal of loss of assets from the middle-class families. We could see a lot of financial harm occurring to individual families because of the physical risks associated with climate change. And stranding of human capital. That's something we don't typically talk about very much, but a lot of skills are going to be devalued as a result of climate change. Demand for new skills will rise, but existing skills will be devalued. For example, the capacity to mine coal, hopefully, will be devalued a great deal within the next couple of decades. The capacity to service internal combustion engines will be devalued a great deal. There will be other demands instead, but this could have a big impact, obviously, on people's capacity to earn a living. Final category of risks is ecological risks. I don't have a lot to say about this, just simply to flag the issue. The IPCC has forecast a massive increase in species extinction over the course of this century, with possibly as much as 1/3 of all known species being extinct by the end of the century. That's, I think, a wild guess in many ways, but it does highlight the fact that there's huge risk to many ecosystems because of climate change. At this point, it's not clear how this will affect human societies, but a lot of biologists suggest it will have a very big impact. For example, one quite possible outcome is an increase in the incidence of zoonotic diseases which start off as animal diseases and then transfer over to humans. COVID is obviously such a zoonotic disease. AIDS was a zoonotic disease. Ebola is a zoonotic disease. So there has already been a significant increase in the frequency and severity of zoonotic diseases. And one possible side effect of biodiversity loss will be a further increase in this area. There could be an impact on pollinating species and thus on agriculture. Agriculture is actually quite dependent on pollination in many ways. The loss of pollinators for a variety of reasons, climate change amongst them, is having an impact on several types of agricultural demand, and that could become more severe. There's also potentially a psychological impact of ecological impoverishment. Ed Wilson, a famous Harvard biologist, has written about what he calls biophilia, which is human dependence on access to nature, human psychological dependence on access to nature. There are emerging suggestions that deprivation from nature can cause stress, depression, and a variety of mental health issues. So that's my list of what I call the direct impacts of climate change. It's a long and somewhat threatening list, I have to say. Let me turn now to the transition risks. These are the risks, as I said, that are associated not so much directly with climate change itself, but with the policies that we will be implementing in order to cope with climate change and to mitigate climate change. Some of these are fairly obvious, so I won't spend a lot of time on them. But there are financial risks, and I've mentioned these essentially. There are the risk of stranded assets as we move away from oil and gas, as we move away from internal combustion engines, as we move away from conventional power stations. There'll be a lot of abrupt revaluations of existing capital stocks, and not just physical capital stocks, but as I indicated, human capital stocks and intellectual capital stocks as well. And as in addition to financial risk, there are what I call financing risks. The real issue here is whether capital markets can adequately fund the massive investments that are going to be needed in infrastructure for the transition to clean energy. A lot of this transition is going to happen in developing countries. And so yeah, I'm not at all clear, frankly, that existing capital markets will be capable of providing the funding necessary for the energy transition in developing countries. Transition is occurring in Europe, transition is occurring in the US, perhaps not as fast as one would like, but relatively smoothly, and the capital is certainly available. But when one looks at transition in India, in China, in Africa, it's simply not clear to me where the financing for that will come from. It seems to me that a lot of that will have to be aided by international agencies rather than being a total reliance on private capital there. There are also supply chain risks. There's a risk of we're going to be radically restructuring our supply chains. For example, there's going to be a massive ramp up of battery production and the extraction of raw materials for batteries. And these sort of radical restructuring of supply chain risks to a fairly tight timetable can always pose risks of supply chain breakdowns. There's also, I think, energy security risks, and we've seen a little bit of that in the last few weeks. But let me go into a bit more detail there. Renewable energy, as we obviously all know, is intermittent. I'm not sure that we fully understand the long-run distribution of wind power and solar power. Now, it's certainly possible that climate change could alter the distribution of wind speeds, which have an impact on the productivity of wind turbines. One of the reasons for the energy problems in the UK this year is that wind speeds were unusually low in Northern Europe this summer. Is that a random event, or is this something we can expect to occur more frequently as a result of climate change? The world is becoming much more dependent on solar power than it has been in the past. A massive volcanic eruption could greatly reduce the amount of insolation and could reduce the productivity of solar power for several years. This is not a hypothetical possibility. This is something which has happened in the last few decades and happened on a very large scale in the last few centuries. So in a world which is heavily dependent on solar power, we could find ourselves short of solar power for a couple of years as a result of a major volcanic eruption. Reduced investment in oil and gas could lead to shortages during the energy transition. Obviously, there's relatively little incentive to invest in a product which is currently being phased out. And the IEA in their recent World Energy Outlook just came out a few days ago made the remark that the current levels of investment in oil and gas are very close to those required in their net zero emission scenario, which is much too small, of course, to sustain continued dependence, significant dependence on oil and gas. So let me summarize this. There's a very, very wide range of climate and transition risks. These have impacts through an extremely disparate range of channels. Virtually no aspect of the economy will be unaffected. Some of these risks are already very apparent: storms, fires, heat, flooding, and so on. But many of the risks are not yet obvious, although if we look carefully, they are appearing. I mentioned there things like disease vectors, the increasing range of disease vectors, the impact of heat on productivity, and so on. There's a big risk of financial capital losses. Some of these are evident and we can anticipate them quite clearly, but others probably will surprise us. So I think we really have to be very much on our feet, and I think it's going to be a difficult time for central banks the next couple of decades. I think there are lots of surprises coming your way, I'm afraid, Sarah.
Thank you very much, Geoffrey. That was an absolutely phenomenal tour de force in casting your eye around all of the challenges that we face as we look ahead. We'll have time to quiz Geoffrey in just a short while, but before that, we're going to move to Dr. Pablo Salas Bravo, who's the Deputy Director of Synergy, the Cambridge Centre for Environment, Energy and Natural Resource Governance, as well as the Prince of Wales Global Sustainability Fellow in Radical Innovation and Disruption at the Cambridge Institute for Sustainability Leadership. Dr. Salas will speak to us about the potential geopolitical and sectoral impacts of the transition. Pablo, over to you.
Many thanks, Sarah, for the introduction, and many thanks also, Geoffrey, for this very good overview on risks. I will move a bit in the opposite direction, going more of a ground level, and look indeed at a scenario analysis related with transition risks. So I can see, now I can see you're seeing my screen. The results that I'm going to show you are associated to the project Frantic, Financial Risks and the Impacts of Climate Change, which was funded by the Natural Environment Research Council of the UK, NERC. And they are pretty much in the spirit that Sarah mentioned before, which is kind of as our data improve, as our methods improve, we need to keep going and keep improving the scenario analysis that we do over time. And indeed, this work that you are going to see here builds on our previous work in the area of stranded fossil fuel assets, which was published in 2018. Now we have a much better resolution of the energy sector, thanks to asset level data for oil and gas. And then we also upgraded the representation of power and transport sectors and built a representation of financial network that allow us to see the impact through equity channels in the financial sector. So I'm going to tell you about these results next. So we will first describe the methods and scenarios used in our analysis, followed by the general results. And then we're going to analyze the key aspect, which is the new energy geography that emerges from these results, and especially looking at the transboundary effects of the changes in energy trade. Finally, if we have time, we're going to discuss briefly the propagation of the transition risks across the equity channel of the financial sector. So let me start with the methods and scenarios. In particular, let me give you a brief introduction to the main platform behind our study. So at the heart of our analysis is the macroeconomic model E3ME, which was developed and maintained by Cambridge Econometrics. This is a highly disaggregated macroeconomic model that has been used extensively by policy analysis in several countries. The version used for this exercise divides the world in 61 world regions, 43 economic sectors in each region, 23 types of fuel users, and 12 energy carriers. Now, inside the 3ME, plotted here outside for simplicity, there is a family of sectoral models that we call FTT. which provide a detailed representation of technology diffusion across different sectors: power sector, transport sector, heating, and industrial sectors. These modules follow a bottom-up approach in which technology adoption is driven by competition and resource use, the latter constrained by a global database of energy resources. Now, the starting point for our scenario analysis are policy assumptions for each of the 61 world regions. These policy assumptions influence the relative competitiveness of the different technologies, generating different macroeconomic and energy scenarios. From each of these scenarios, we obtain a large data set of variables such as economic output per sector, employment, income, and so on. Of course, one of the most relevant variables is emissions, driven mainly by the use of fossil fuels in different sectors. And we connect emission trajectories coming from the scenarios with the Gini emulator from the Open University to analyze the impact on climate change. The overall platform that you see on the screen now is called E3ME FTT Gini. So now, using this platform, we focus our study into four main scenarios. The first scenario is that we call INV-E for investors' expectations. And here we disconnect our sectoral models and plug into E3ME assumptions that are compatible with the new policy scenarios from the International Energy Agency. So this is an exogenous baseline scenario, if you may. This exogenous baseline has a median warming level of 3.5 degrees Celsius. The second scenario, we call it technology diffusion trajectory, or TDT. And this one takes into consideration existing trends in technology diffusion in the energy sector captured by our own macro models. And here we don't assume additional climate policies, and we reach a median warming on 2.6 degrees Celsius. And we have a 2 degrees C compatible and a 1.5 degrees C compatible scenarios. The 2 degrees C compatible scenario, we call it net zero in Europe and East Asia, or Europe, East Asia net zero, because it assumes policies compatible with the UK, the EU, Japan, and Korea reaching net zero in 2050, while China reaches net zero in 2060. And here we have a 50% probability of not exceeding 2 degrees Celsius. And the 1.5 degree scenario, which we call net zero, uses stringent policy assumptions in some of the regions and assume that all of them reach net zero in 2050. So now, based on this modeling platform and the scenarios that I just showed you, let's take a look at the new energy geography that emerges from our analysis. Here we can see a snapshot of the four scenarios, which are represented as columns. The top rows represent global supply of fossil fuels and renewables, while the three bottom rows show regional disaggregation of fossil fuel supply, fossil fuel demand, and renewable supply. As we can see in the first column, the supply of fossil fuels remain strong in the exogenous baseline scenario, driven mainly by the demand in the power and transport sectors. This scenario portrays a strong demand for fossil fuels, particularly in Asia and the rest of the world, compared with a limited uptake of renewable energies. By contrast, in our own baseline, the TDT scenario, we project a rapid and continuous growth of low carbon technologies at the same rate as observed in the historical data. In the UEA net zero scenario, which is compatible with 2 degrees Celsius, we can see a similar behavior, but with a faster uptake of low carbon technologies, driven by policies in the countries with net zero targets. In this case, would be mainly Europe and East Asia. And finally, in the net zero scenario, low carbon technology is adopted at a faster pace than in the other scenarios, driven mainly by policy support across the board. But also you have a lot of cost reductions due to learning by doing. Now, due to the stringent emission reduction targets, the net zero scenario relies on a conservative but still significant amount of negative emissions, and they come mostly from bioenergy with carbon capture and storage, or BECCS. But they are still small. They are in the order of 2 gigatons of CO2 per year in 2050. Now, in all these scenarios, with the exception of the in E, which is the baseline exogenous scenarios, solar PV becomes the lowest cost energy generation technology by 2025-2030 in regions obviously with appropriate levels of solar irradiation. As a result, there is what you can see as a winner-takes-all phenomenon. And we can see a very similar phenomenon with electric vehicles in the transport sector later on. Happy to discuss this about in the Q&A section. Now, in a nutshell, what we are seeing is that in our endogenous scenarios, there is a rapid growth for renewables, even if there is not further climate policies in place, with underlying gains in energy efficiency and a lower energy demand in comparison with the in E scenario. Most interestingly, we can see the emergence of a new energy geography as energy trade declines and local production of renewable electricity grows. As we will see later, changes in the trade of energy will have significant impact across regions and sectors with clear winners and losers. Now, for this particular study, we increased the resolution of the energy sector and looked at changes in the fossil fuel production at the asset level. And here it's very important to highlight that despite oil being a global commodity, the underlying process of extraction varies radically across world regions. On one extreme, you have conventional oil in places such as Saudi Arabia with very low cost of extraction. As you move towards resources that are more difficult to extract, the competitiveness of the underlying industry, of course, decline. Now, for the Frantic project, we use asset-level fossil fuel data from the Rystad database, which included around 70,000 sites worldwide, separated by company and country. In the charts that you see on the screen, you can see the cost distribution of resources in blue, 2P reserves in yellow, and production in red for different world regions, with oil in the top and gas at the bottom. The vertical axis here shows quantity, whilst the horizontal axis shows cost distributions based on break-even price of production. In simple terms, the horizontal axis indicates the commercial price at which these resources become competitive. And by just looking at this data set, you can immediately infer a very few interesting points. First of all, the cost distribution of oil and gas varies massively across regions. Places such as Saudi Arabia and the rest of OPEC have most of its oil in particular at a very competitive cost of extraction. By contrast, places such as the US, Russia, and Canada have much higher cost of extraction. Consequently, in a price war, OPEC can outprice all these regions easily. On top of that, there are enough resources in the OPEC regions to satisfy the demand for oil, especially in low carbon scenarios. And this makes the previous point about OPEC outpricing other regions even more relevant. So the corollary here is very clear. Resources are not evenly distributed, and substantial amounts have a low likelihood of ever being used if the demand of fossil fuels goes down. And those are located in different world regions. So here I will stop a bit and highlight that many studies portray the low carbon transition as a prisoner's dilemma. So if you follow that argument, countries have the incentive to free ride on other countries taking climate action. However, what the energy geography is showing us is that the incentives for fossil fuel importers, for competitive fossil fuel exporters, and for uncompetitive fossil fuel exporters may be completely different. So therefore, it's important to take a glimpse to the political economy behind the energy transition. Sorry. Here we can see the sectoral impacts of the transition, looking at differences between two main scenarios, the exogenous investment expectation scenarios and the 2 C compatible scenario, EU-EA net zero. Now, due to the internal trade of energy, what we see here are transboundary sectoral impacts with very clear winners and losers. The sectors, you can see them here at the bottom. Now, for fossil fuel importers, they are in the right-hand side. They are better off in a low carbon scenario with the obvious sectoral exceptions such as extractive and fossil fuel industry sectors and utilities. So if you compare the low carbon scenario with the high carbon scenario, which is the comparison that you're seeing here, these fossil fuel importers have a positive change in output. So they are better off in a low carbon scenario. Now, for the competitive fossil fuel exporters, such as Saudi Arabia and the rest of OPEC, that you see here at the bottom left, they also manage to stay positive as they're able to keep control of global fossil fuel markets because of their competitive resources. However, for the non-competitive fossil fuel exporters, such as the US, Russia, and Canada, at the top left, the losses in the fossil fuel sector propagate through the rest of the economy, creating strong negative effects. Now, to understand these results, we need to take a look at how decarbonization impacts the real economy in the macroeconomic model E3NE. Now, on the one side, the increase in low carbon investment produces a boost in the economy, driving building activity, for example, in low carbon sectors, and creating the corresponding positive impacts on GDP and jobs. On the other side, a decline in the demand for fossil fuels produces a decline in fossil fuel prices, a decline in production, and the corresponding losses on GDP and jobs for fossil fuel exporters. That propagates to the rest of the economy, first domestically and then internationally, through supply chains which are modeled using input-output tables. Now, in terms of trade balances, for importers, the low-carbon transition reduces their energy imports and redresses trade balances, generating, in general, positive effects in income and GDP and competitiveness. That is what we saw before with the cases of Europe, China, Japan, and India. Now, for fossil fuel exporters, such as the US, Canada, and Russia, the shock in demand produces negative effects in the fossil fuel industry, creating job losses and negative GDP impacts. Now, what happened with the competitive fossil fuel producers? Well, they actually face a difficult decision because they can, on the one side, maintain production low in order to stabilize prices, or they can go to a price war and grab market share. And we analyze those scenarios under what we call quotas, so in a scenario in which OPEC maintain current shares of oil and gas markets, and a scenario that we call sellout, in which they grab market by increasing production. Now, of course, I don't have time to show you all the results because we did this for all the scenarios. So I'm just going to show you briefly one particular case, which is the comparison between the reference in E scenario with the 2-degree scenario, EU-EA net zero. So here you're seeing in the left-hand side, the scenario with quotas in which kind of the OPEC restrict production, and the scenario with sellout in which they increase production for several world regions and some macroeconomic variables. Royalties at the top, GDP in the middle, and employment at the bottom. And in general terms, what we see is that actually fossil fuel importers, such as EU, China, and India, are, again, better off, particularly in the SAO scenario, because they get lower prices of fossil fuels, while the OPEC maintain a slight positive outcome because they grab markets, but there are very strong GDP and employment losses in fossil fuel exporters such as US, Canada, and Russia. Now, I'm going to skip to the end here, which is the picture that we're seeing in the American economy is that on the one side, importers are getting better off with the low carbon transition, but high cost producers can suffer one or a double loss. If they embrace the low carbon transition, they still have to close down their fossil fuel industry because they are outpriced by OPEC, but at least they can benefit from the low carbon investment. But if they decided to stick to the fossil fuel industry, they still are going to be outpriced by OPEC. While the lowest cost producers face a scenario of last man standing in which they can either maintain strict quotas or flood the markets. And in both case scenarios, they are relatively slightly better or slightly worse off, depending on very specific assumptions. So this is the very new energy geography that we're seeing. And actually, we believe that it's very important to discuss it now with fresh eyes. Thank you very much.
Pablo, that was fantastic. Another tour de force and quite different in kind to Geoffrey's presentation, but helps us really understand how detailed modeling of the various facets of this transition are going to really matter. Now, we're in a Q&A session now. We have 20 minutes until past, and then you'll all be keen for a well-deserved cup of coffee before the next fabulous session. Please, for those of you who would like to put questions either to Geoffrey or to Pablo, please type them in the Q&A box as it says in the chat. Just put the little 3 dots next to chat, and I'm happy to put them to our fabulous panelists. But I'm going to use chair's prerogative and fill the void with a question for you, please, Geoffrey. You showed us a really wide range of risks, all of which we see looking forwards rather than looking backwards, which are disparate and heterogeneous in nature, but which together add up to potentially significant, potentially systemic risks, which, as you so beautifully said, would cause central banks a bit of a problem. In that context, how do you suggest we approach trying to model and size those risks so that we can drive the different decisions today that will reduce those future risks?
I think basically what you're already beginning to do through the NGFS, which is that you need to think through scenarios here. We don't have a lot of information about some of these risks, unfortunately. So I think it's, we couldn't do, for example, the kind of detailed modeling that Pablo was just talking about on the energy sector, because we don't have the data or the analytical understanding necessarily for some of the risks I'm talking about. I think that, you know, scenario analysis, where you talk with people in the field and develop some possible scenarios, is really the only way we can proceed with these. And at least, even if the scenarios are not particularly accurate in the end, and it puts the issues on the agenda and gets you thinking about the kinds of policy responses. So it's, you know, it's qualitatively useful, even if not necessarily quantitatively useful. And I think that's probably a big step forward at this point.
I very much recognize the way you articulate it there, Geoffrey. When I think about the climate exercise that we're doing, the climate BES that Andrew Bailey mentioned earlier, we think of it as doing 3 things. Firstly, trying to shine a light on risks that are currently opaque. But then secondly, driving a discussion about, so what are we going to do about that? What are the qualitative responses to these risks? And then thirdly, driving better risk management, all of which are useful. Pablo, a question to you, if I may. Your work is fabulously detailed, deeply grounded investigation into the effects of transition on energy producers, and you know, the fabulous insight that you had that the allocation of losses and the impact on growth as the world decarbonizes is going to fall quite differently across different geographies, different countries. How do you think we should use that insight? It seems to me, sat here in London, headed to Glasgow in a fortnight, that this kind of analysis could be really material in thinking about how best to react to the challenges that we face as we look ahead. But I'd be really keen, Pablo, to hear your thoughts on that. Oh, Pablo, I think you may be on mute.
Thank you very much. Apologies for that. Indeed, when we see these scenarios, particularly for people which is not connected to the energy sector, they maybe look like very far away scenarios. They have nothing to do with me. But actually, the second part of this research, we took the losses that we see in the energy sector and we saw how they propagate in the financial sector. First of all, looking at who owns those assets, then who owns the companies that own those assets, and then who owns the company who own the companies who own those assets. And actually, what we're seeing there is that there is a geographical transfer of losses and risks from developing countries where the oil wells are to the countries where have the headquarters of the companies. But then when you see who owns those companies, there is a variety of investors that go from public sector, from private sector, including pension funds, equity funds, and so on. So therefore, it's pretty much in all of our balance sheets, the risk associated to these losses. And therefore, we need pretty much, I would say that the main argument for me to move forward is to bring transparency, to ask companies to be very transparent regarding where their investments are so we can take better decisions.
Great point. Absolutely. Really insightful. There's a question for you, Pablo, that's come through the chat box. How do you think about potential border adjustments, and how might they, you know, the carbon border tax type idea, and how do you think that might play into the macroeconomic outcomes that you highlighted in your work?
Well, what we saw in our analysis is that pretty much fossil fuel importers were better off by decarbonizing, which sounds like a relatively natural scenario, right? The price of oil decreases, and there is more low carbon investment, and therefore they are better off. However, if we now put the burden not only on the producers of goods, but also on the consumers of goods, probably the risk is going to be shared differently. So we can see that there could be some propagation of risks associated to this carbon adjustment. And of course, it will depend on the very specific structures of the different economies.
It's a really
Can I possibly ask Pablo a question?
Of course, please do.
So Pablo, I really enjoyed your paper, by the way. I thought it was a great piece of work.
Thank you.
And it's very original. I haven't seen that done before. What would happen if you broke down fossil fuels and made a distinction between oil and gas? Because it seems to me that we want to move away from oil, but there is potentially some demand for gas on a somewhat longer scale. And for example, your comments about the impact of this on the US. Now, the US is not a low-cost oil producer, but it is a low-cost gas producer. So I can see that actually changing the political economy of this quite a bit if one were to distinguish in more detail between oil and gas here. I just don't know if you've got results on that yet. I'm sure you're thinking about it.
Yeah, well, in our analysis, we focus particularly on oil and gas, and we also have coal, for instance, but coal because it's a much lower value fossil fuel, you don't see much of the financial risk being transferred because a lot of economies are already going out of coal. Now, what we see in terms of oil and gas is we see a similar effect, a temporal effect with coal, oil and gas, right? In which you can see economies typically getting rid of coal first, and then oil is mostly used in the transport sector. So as the electric vehicles start to operate, then you see a decline in the demand for oil. Now, gas has the advantage of being providing flexibility, particularly for the power generation sector. And in that sense, you can see that it typically lasts longer in different scenarios because it is used in low carbon scenarios. So when you have a large amount of solar and wind, typically you have complementary large amount of gas. So in that sense, we can see a phase out first of coal, then of oil, and then of gas. But of course, the speeds of those phase out change in different geographies, and of course change overall as we put the carbon targets down regarding with our climate objectives.
Thank you.
Sarah, may I jump in?
Please do.
I want just to recall that also the people that is here in presence can ask questions using the mic over there. And I really like to ask a couple of questions. One to Pablo. That is, if you accounted in your endogenous transition scenarios also for raw materials needed for the electrification of energy use, copper and this kind of stuff. So just to understand if your map of energy trade can just change because you get rid of fossil fuels, but you have new energy related materials. And the other one is to Professor Heal, to better understand ecological risk. These days we talk a lot, we talked a lot in the G7 and G20 tracks, for example, about the role of nature and biodiversity. And, it seems really hard to model this stuff as a potential financial risk. So if you can elaborate a bit on how to model this ecological risk he was speaking about before. Thanks.
I second that question, Professor Heal. That was headed your way from me. Anyway, Pablo first.
Yeah, I'm going to be super brief because I also want to hear the answer from Geoffrey. We have a limited representation of material use in the macroeconomic model 3ME in the sense that it's included in some of the sectors, but definitely in these very high renewable scenarios, we probably need a better understanding of how material use will be used. So I would say that is a work in progress.
Okay, so I'm on the spot now, am I?
Good luck, Geoffrey. We're all hoping there's a way through this. Yeah.
I find it, I think it's a fascinating question, and it's totally appropriate to ask it. I'm not unfortunately sure that I can say an awful lot by way of an answer. Let me just make a couple of remarks. So what's the nature of the risks that we face from biodiversity loss? I think I'd say a couple of things. There's a couple of specific risks that we probably do understand a bit. One is, as I mentioned, the risk of zoonotic diseases. So I think that this does enhance the risk of another pandemic. And we've already seen, what a relatively mild pandemic can do. COVID-19 has been very disruptive, but it's not. If you compare it, for example, I've been reading recently about Black Death in Europe in the Middle Ages. Now that had a 90% fatality rate. So imagine something which is as infectious as COVID, but with a much higher fatality rate. Obviously, the cost of that could be absolutely huge. And there's really no knowing what kind of diseases are out there in terms of zoonotic diseases that could transfer over to humans. Second thing I'd say is that one of the most important and quantifiable risks of properties of biodiversity is it provides us with insurance against sudden loss in crop yields. For example, on a number of occasions, we found that a major food crop has been infected by some kind of pest, and that it's very hard to breed in resistance to this pest. And the pest is resistant to many kinds of pesticides and so on. And we've overcome this problem by actually finding a close relative of the food crop, which is immune to the pest, and then transferring the immunity genetically from the close relative to the actual food crop. And that's happened with rice, it's happened with corn, it doesn't usually get headlines when it happens, so we may not even know about this. But in fact, we'd have lost a lot of the world's rice crops and a lot of the world's wheat crops and corn crops if it were not for the existence of close relatives of these, which happen to have certain immunities to pests, which the food crops didn't. So that's the importance of having a kind of a reservoir of biodiversity from which you can transfer valuable properties to food crops. And I think that if you lose that, again, the risk of a sudden hit to a major food crop from a pest is very high. It's hard to quantify that, but if you look back historically now, people who specialize in the agricultural field can give a lot of examples of this type of thing happening in the period before we were able to make these transfers. So that's probably, going back to your question to me earlier about scenario analysis here, I think you probably, with the right people, could construct scenarios about this. So I'd say that, in answer to the question, there are two things I can think of which are big risks, which we probably understand a bit as a hit to the food supply, hit to a particular food crop, and another really nasty pandemic.
I agree with that, and I think kind of the idea of trying to think about what are the equivalent shocks, the equivalent scenarios, and seeking to identify those, whether it's zoonotic diseases or crop yields or some other aspect, and play those through, learning from history as appropriate, seems to me to be a very wise thing to do, and perhaps something we should invest in. And I encourage everybody participating today to take up that challenge. Ivan, are there any other questions that you've got?
Well, it seems on the chat there is Hector De Santis that is asking to Pablo to elaborate a bit on the problem, that was mentioned also the professor, of solar or wind intermittence in producing energy. And Hector as well is also asking if carbon tax can provide a faster and more homogeneous solution instead of two-sole supervision of central banks. So, I think that both speakers can answer these questions.
Yes, both interesting questions.
Sorry, could you repeat the first one, because I don't see it in the chat?
The first one is asking to elaborate a bit on solar and wind variability in providing power. Yeah, this is, at least in our scenarios, is not only at the global level, but especially when you look at the regional level, is important, and we believe that it requires further studies. Now, the main uncertainties that we see there is on the adoption of technology. Now, most of the studies currently look at kind of rates of adoption, and they extrapolate into the future, but those rates of adoption may change. There is also an aspect of flexibility of the grid, which is connected with, on the one side, trade. So if you have a country which has trading with their networks with different energy sources, then that improves flexibility, but also you have design of the grid flexibility. For example, one of the aspects highlighted by the International Energy Agency in India is that they need more professionals, electrical engineers, to work in these issues in order to interconnect this very large network. But when you are interconnected already, then you have different regions provide their backup for the other regions. So actually there is plenty of more to know about the flexibility. So the knowledge that we have about that is relatively limited. And regarding carbon tax, definitely carbon tax is one of the measures which is not sufficient, but is definitely necessary. And I'm sorry, Geoffrey, if I took it too long, but also want to hear your view.
No, I totally agree with what you said, actually. That's great. Yeah, on intermittency, that obviously is a big issue. I mean, there are three responses to that. One is what Pablo just said, which is great. It's unusual. And if you have regions, if you think about wind, if you have regions which are sufficiently far apart, then the probability of the wind going down in both regions at the same time is fairly low. I mean, technically speaking, the covariance between wind sources drops with distance. So if you can integrate wind sources over large distances, and we're talking here about thousands of kilometers for this to be effective, then you can, to some degree, mitigate the risk. So we need to see more of that. The other response is obviously batteries for short-term storage. and battery costs are coming down a great deal. And here in the US, at least, a lot of the big utilities are incorporating batteries with a sort of a half-day storage capacity into their grids. And then, of course, there's, for longer-term storage, the potential for hydrogen, which is something which has been discussed a great deal, but is still, I think, an open question. Hydrogen is a mechanism through which we can store energy from, summer to winter or something of that sort. And we need more development of hydrogen-based technologies. On the carbon tax, I think carbon taxes have a very different impact depending on which fossil fuel you look at. If you look at coal and gas, they're actually very vulnerable to a carbon tax, in the sense of a relatively modest carbon tax, $50 a ton of CO2, $60 a ton of CO2, will make both coal and gas uncompetitive. Oil, that's actually much harder to move out of the market with a carbon tax. It takes a carbon tax of a couple of $100 a ton to have much impact on oil, largely because there's no immediate substitute for oil. The elasticity of demand for oil is rather low because we don't have many alternatives for aircraft, we don't have many alternatives for ships, and at the moment we are beginning to see an alternative for ground transportation, but it's only very thin on the ground. So demand for oil currently is extremely inelastic. You have to put the price up a long way before you force it out of the market. That could change, obviously, as electric vehicles become more competitive and spread.
Brilliant. Look, we are at the half hour. That was an absolutely fascinating session. Andrew Bailey opened in his opening remarks, said we need help from academia to help us better understand the challenges ahead. And I think Geoffrey and Pablo, you have done that brilliantly. I've taken 3 learnings from this. Firstly, underline the value of the scenario analysis that we're already doing. Secondly, underlining the scale of the intellectual challenge ahead of us. We have to do the kind of deep, rigorous analysis that Pablo has set out across a whole range of transmission channels, as you highlighted, Geoffrey. So the scale of the challenge in front of us is immense. And now we've got to start thinking about the wider environment as well. So a fabulous session. Huge thanks to both of you. And Ivan, I will hand it back to you in Milan.